production was better than expectations. And I'm curious, I guess, on that front as to whether that should continue to be the expectation of the market, that you will beat what at least have been the expectations for production thus far.
Well, David, it was a good quarter, and we've been investing steadily in growing our production. We had a record in the Permian Basin, up 15% year to date versus the same period last year. We had our strongest ever production out of our Australian liquefied natural gas business. The world needs more supply, and we're delivering that, and we're winning back investors. We delivered higher returns. Year to date, our return on capital employed is well above 20%. Our cash yield to shareholders is 7.5% if you take the dividend and the buyback together. We're delivering lower carbon, and yet we still trade around half of the market multiple. Energy represents about 5% of the S&P 500 by market cap, but more than double that in earnings. So we're performing well, and we intend to continue to do so.
Yeah, it's funny you mentioned the multiple because I am curious. The buybacks, they continue. What is it, $3.75 billion of common during the quarter? Well, that was basically in line with your guidance. But at what point, given the chart that our viewers are looking at right now, do you feel like, you know what, maybe my stock's getting less cheap and it's not worth spending that much of shareholders' money on buying it back?
Well, David, we're doing it all, quarter in and quarter out, year after year. We've raised our dividend for 35 years in a row. We were up 20% beginning in 2020 through COVID when many in our industry cut or held flat. We've been investing to grow both our traditional and our new energy businesses. Our spend this year is up 50% versus the same period last year. We've got a strong balance sheet, and we've bought shares back for 15 out of the 19 last year. So we've got a very balanced approach to capital allocation. We've been consistent and disciplined through the cycles of the business, and we intend to continue to stay consistent and disciplined as we go forward.
Mike, Jim Cramer, it's great to have you on the show.
Good to see you, Jim.
Mike, I'm reading this methane report you just put out. It's rather extraordinary, and it makes me feel that we are thinking of oil companies incorrectly. I know that there's a view, we talked about Larry Fink's view, say from BlackRock, oil's either good or oil's bad, or we should say that this group is brown and this group is green. What you're doing with methane is basically saying, listen, we're going to take a leadership, we're going to do our best to stamp out methane wherever we can. This distinguishes, to me, that Chevron's well ahead of everybody else. Are we ever going to get to the point where we're not going to consider oil companies as equal when it comes to getting rid of emissions?
Well, Jim, what we're doing is trying to meet the world's growing demand for energy and do it in a way that reflects the expectations for lower emissions and lower carbon emissions, lower greenhouse gas emissions. We've been a leader in methane management. We design facilities, we operate facilities to keep the methane in the pipes, and we're finding increasingly effective techniques to identify leaks and emissions and address those. We report very transparently. So our intent is to be a part of the energy future. We intend to meet the world's needs today, but also invest in new technologies, not only methane management, but renewable fuels. We, earlier this year, completed an acquisition. We're now the second largest biofuels and renewable diesel producer in the United States. We're investing in carbon capture, hydrogen, other technologies to lower the emissions profile of energy use across the economy. And so, look, I think that we've been around for 143 years. We intend to continue to be a very responsible player, and the methane report, I think, is just one example of that.